Now, on to the next session. I'm glad to have on stage Jan de Jack and Jelena Makura from ING. So we'll continue to spark your curiosity with a presentation talking about more the wholesale banking and the implementation of sustainable finance solution. So next presentation, the impact of increased regulation on sustainable finance solution. Welcome Jan, welcome Jelena.
Hello, good afternoon, everyone. Indeed, this afternoon we will discuss the impact of increased regulation on sustainable finance solutions or sustainable finance products. And the way that the presentation this afternoon will be structured is I will provide a sort of scene setting with an overview of the sustainable finance regulatory landscape, not just on the EU side, but also considering global movements. And then my colleague Jan will focus more on the sustainable finance solutions or product offering. And then, of course, at the end, we're happy to answer any questions. So just to start the session, indeed, sustainability is quickly becoming an integral part of finance. Sustainability is no longer an afterthought in financing discussions. Rather, it's a strategic choice that, and discussions happen right at the beginning. Now, if we look at all the different kind of levers that have contributed to the uptake of this thought, we're seeing an increased political focus driving sustainability considerations in financing. We're seeing an increased regulatory focus, maybe concentrated in certain jurisdictions first, for example, in the EU, but other jurisdictions are quickly catching up as well. For example, the US, but also Japan in many instances. Of course, there are increases in ESG-focused investors or investors who are interested in embedding sustainability considerations in their investment decisions. And then, of course, there is the financial sector push. You've seen banks like ING, who are aligning their strategy with global commitments, including the Paris Agreement, but also with UN SDGs. We see more commitment, for example, with UNPRI, and then also the Net Zero Banking Alliance. And then, of course, where would we be without stakeholder pressure? And that's stakeholders across the spectrum. So you have NGO, civil society pressure, you have pressure from clients, everyday consumers of financial products, and then, of course, on the regulatory side as well. And then, of course, there is also a push for just more sustainability-related disclosure, and you're already starting to see a trend of moving away from comply or explain to comply and explain when it comes to transparency. Now, when it comes to quite possibly the most mature body of sustainable finance regulation, we really look towards the EU Sustainable Finance Agenda. And in particular, I'm talking about the beginning of the EU Sustainable Finance Agenda, which is the 2018 Action Plan for Financing Sustainable Growth, where it's one strategy that's rooted in 3 key objectives and encompasses 10 different actions. Now, if we look at the renewed Sustainable Finance Strategy, which came out in 2021, it still focuses on those 3 objectives regardless. So maybe if I can zoom in on some of these dossiers, which I'm sure are very familiar to everyone here. One of the sort of core elements of the EU Sustainable Finance Agenda is the taxonomy regulation. And in fact, it's action item number 1 in the 2018 Action Plan on Financing Sustainable Growth. So it's been in progress and in development for the last few years, of course. Now we're in implementation, and implementation hasn't necessarily been as sound as we would have liked as intended users of taxonomy information, but also we have our own disclosure obligations as a bank. The first round of sort of information that we're seeing, it's not necessarily reliable, it's not very consistent, and it's not very comparable. There are examples of one-to-one peers where they've taken different approaches to taxonomy-related disclosure, and it's not necessarily the fact that one of them is wrong and one of them is right, it's just that there's no right way to do things due to lack of standardization and the fact that this is brand new legislation. Also, something to note, and what we've had an observation on, is that sustainability-related disclosure, it's not like financial disclosure, where it's a plug-and-chug operation, you put in some numbers, you get some numbers as an output. Rather, it's a lot of qualitative and quantitative data sources that you then mix together, and you get not necessarily a nice whole number that you can work with. And as intended users of this information, we can't necessarily, at this stage, make long-term investment decisions of 10 to 15 years based off of the taxonomy disclosure that we're seeing today. Other key files under the EU Action Plan on Financing Sustainable Growth, for example, SFDR, is one that I won't necessarily dive deep into, but as we've heard from session 1 and 2, there are also some challenges when it comes to implementation there. There's a lot of subjectivity to certain terms. For example, what is a sustainable investment? Does it connect explicitly to taxonomy regulation, or does it fit somewhere else? Again, lots of room to improve. And then, of course, there are other bits. For example, in the first session, we heard about the ESG ratings regulation. That is also part of this action plan on financing sustainable growth. Maybe another bit here that's important when, well, for all stakeholders is the Corporate Sustainability Due Diligence Directive, which is still under discussion, but it's also actually action item 10 of the 2018 Action Plan on Financing Sustainable Growth. So all of this to say that the EU Sustainable Finance Agenda is progressive development, yes. It's one of the most mature bodies of sustainable finance regulation we can refer to now. But if I could make a conclusion on this slide, I would say that with EU sustainable finance regulation, there's growing pains when it comes to implementation, and the impact will be a slow burn at the end because this is all brand new. Financial and non-financial corporates are still grappling with how do we make, for example, a taxonomy assessment? What are the right interpretation decisions I need to make? What are the right start and stop parameters that I need to put in place? So lots of room to grow, but of course, where there's challenges, there's also opportunities. Maybe to also move a little bit away from the EU Sustainable Finance Agenda and to look a little bit forward into other jurisdictions. The EU and companies that are in the EU, they don't operate in a European vacuum. They have a global footprint. So there are other elements that will also affect them in the sustainable finance space, aside from EU regulation. But maybe just for consistency, I'll continue with the EU regulatory bit. So looking forward, we'll likely see a review of key components of the EU Sustainable Finance Agenda and key themes we've seen in the last slide. We've already seen a review of the SFDR. We're seeing a potential review of the taxonomy regulation in the future to include more transition and enabling considerations. Just yesterday, the European Commission, along with the EU Platform on Sustainable Finance, launched a feedback mechanism whereby stakeholders can propose additional economic activities to be included in the taxonomy delegated acts, as well to propose amendments to some of the technical screening criteria. So again, lots of moving parts, essentially. And then also, one element that was mentioned also in the first session is that there are some regulatory spillover effects when it comes to the EU Sustainable Finance Agenda, where it doesn't necessarily just affect one policy area, rather it'll spill over into industrial policy, it'll spill over into agriculture, it'll spill over into chemical-specific legislation, so it's not kind of a one and done operating in a vacuum situation. There's also going to be an increased focus on the just transition, the context of looking at how do we tinker with the taxonomy regulation to account for more transition considerations, but also looking at how do we push forward elements of transition finance. We've seen transition finance being discussed more maybe in international fora and international kind of configurations, like the G20 Sustainable Finance Working Group and the International Platform on Sustainable Finance, but we're seeing that distilling down to the EU, and there's very likely going to be some regulation in this space. And then, of course, something that we'll also probably see with EU regulation, the Commission likes to regulate everything. So very likely you'll see areas where there's only market guidance in existence now, the Commission coming in, doing an impact assessment, saying, this isn't working, voluntary market guidance isn't enough. We need to come out with our own dedicated piece of legislation. And this is what we saw with, for example, the development of the EU Green Bond Standard, which up until that came along, you only had the ICMA Green Bond principles in place. Then, of course, as I mentioned, European companies usually don't operate in a European vacuum. They have a global footprint, so there's some global considerations that need to be taken into account. I mentioned a lot of international fora discussions like the G20 and IPSF, but also there are a lot more questions now on extraterritorial application of a lot of EU legislation and how do we deal with interoperability considerations. For example, under the CSRD and the European Sustainability Reporting Standard, if a company is reporting against those standards, would that make it that they're automatically compliant with GRI or ISSB? Those questions are still unanswered and still subject to discussion also in the Commission. Then, of course, one of the key pillars of the EU Sustainable Finance Agenda, the EU taxonomy. Other jurisdictions have embarked on their own taxonomy journeys that don't necessarily mirror what the EU is doing. For example, China has its own taxonomy, which actually includes coal. But when you look at the EU taxonomy, power generation via solid fossil fuels, so coal is explicitly excluded. So how do we look at kind of interoperability between those two taxonomies if you have companies that are operating in both jurisdictions? Then you have, for example, the Japanese taxonomy, which focuses more on transition and doesn't necessarily look at is this activity sustainable or is it not sustainable? So lots of kind of movements. And then, of course, you have whispers of a transatlantic taxonomy between the US and the EU, but to be decided if that'll come to fruition. So how will all those things work together? How will reporting frameworks be consolidated? How will interoperability and equivalence regimes be established? Those are open-ended questions. And then, of course, you have EU supervision, but also non-EU supervision to take into account. You have the three regulators that we all are very much used to that are working on their own sustainable finance policies, templates, disclosures, etc. But then you also have movements happening in the UK. For example, the Financial Conduct Authority is looking at how do we implement supervision in the sustainable finance space. But also there's movement in the US with the SEC, cracking down on labeling of certain funds when it comes to whether or not they include sustainability-related considerations. So again, just to conclude, in this space, it's really growing pains with implementation, and it's a slow burn with impact. But of course, as was said in the first slide, sustainability is a strategic choice, and it's really no longer an afterthought.
Thank you. What I have included also for today is the focus on the impact of regulation, specifically on sustainable finance solutions. Now, solutions are something where we consider across service categories within a wholesale bank as an institution. So basically, that means loan, capital market, but also working capital financial solutions whenever there is a sustainability overlay in solutions we have within wholesale bank. I have three topics to share today where I thought it would be interesting to give our considerations. First is, of course, the impact of regulation versus the concept of a sustainability-linked loan. That's the one thing. Secondly, the difference between use of proceed categories and the sustainability-linked general corporate purpose funding. Third, transition. We've heard already the word transition multiple times today. It's a key focus today, but even more so in the future. And then also a look forward in 24 and beyond when it comes to sustainable finance solutions and sustainable funding. So on this slide, you see an overview of sustainability-linked loan principles by the LMA. I think that concept is known by everyone, but just a few key topics. First, you need to select your KPIs, which needs to be measurable, material, and of course, needs to be benchmarked. You have to set calibration of your KPIs. It needs to be ambitious. you have to set a kind of a correct understanding on how to set the bar when it comes to the ambition level of the KPI. You need to also, of course, properly measure the economic impact as being coded on the slide through the principles, meaning there is an adjustment on the pricing, specifically when it comes to the achievement or non-achievement of KPIs, with a margin effect both ways, so you can have a discount, but if not achieved, there is also a premium being applied. It's about reporting. Companies will have to report properly on the structure of such a facility, meaning with actions are being undertaken to achieve the KPIs and properly indicating the achievement of the KPIs throughout typically their non-financial report. And lastly, there has to be a verification on the data quality. So that is the concept of a sustainability-linked loan. Now, how do we see the impact of regulation, as explained by Elena, specifically on that product? Well, it's clear for us that more regulation is more disclosure is more data is long-term view, and you have more concept to have a specific KPI setting according to the strategy and the sustainability strategy of the group. So for us as a structuring coordinating bank, in many of those facilities, it's important and it's a positive situation to have more data availability to assess properly setting up these structures. What is also important these days is to look into the impact logic. What actions are truly being undertaken to achieve the KPIs? What is the planning? What is the medium-term look? What are the actual CapEx expenditures specifically to achieve the KPIs of these facilities? And hence we have also seen that the LMA has an updated guideline, specifically policy paper on sustainability-linked loans, which provide more harmonization in the market, but also more scrutiny when it comes to assessing the structures by banks and by companies themselves. So it's fair to say that the past 2 years, clearly the due diligence process on sustainability-linked loans within banking and within corporates has changed massively, and it has to be a thorough exercise to make a clear impact. I think that's the logic of the first overview. Second, there we have the focus on specifically the difference between use of proceeds and sustainability linked. I have included a graph specifically from Bloomberg New Energy Finance, where you see already a number of use of proceed categories: green loans, green bonds, social bonds, and sustainability bond. Sustainability bond being a combination of green and social use of proceeds. As a direct look on the graph, you immediately see that from first half 19 till first half 23, it's fair to say use of proceeds have provided a solid backbone in the market of sustainable funding. And our expectation is that it is continued to be so, and it will even gain ground going forward. Now, why is that? Because use of proceeds, of course, are linked to specific asset classes, specific CapEx, OpEx, which have to be funded on a one-on-one basis with a specific use of proceeds understanding, adhering to the guiding market principles from either the LMA or the ICMA. And that's a very important logic we see. Secondly, the SFDR, as already touched upon today as well, a very important regulation for investors. They have to disclose to which extent they allocate their investments into green funds or green investments, one thing. Secondly, when it comes to the SFDR, they will also have to disclose their commitment towards EU taxonomy alignment. So that will also support the use of proceeds funding for a number of key industrial sectors going forward. Social use of proceed category, clearly there, the definition of sustainability today goes beyond environmental aspect only, because certainly since COVID touched the world 3.5 years ago, we saw that the use of proceed categories in social loans or social bonds have increased significantly, as you also see on this graph. It's also fair to say on sustainability linked, a KPI typically is also linked to social areas of consideration within the sustainability definition. Now, on the contrary, that also means if you see a growth in certain use of proceed aspects, Then we have also another aspect, which means the sustainability-linked market is noticed to be on a decline. However, there are a few considerations to make. On the right-hand side of the slide, you see indeed a contraction of the sustainability-linked loan market. Now, a few reasons. First, it's fair to say the market is fairly mature for large-cap segmented corporates or issuers at large. The product has been set in the market more than 6.5 years ago. So the first wave has been implemented, and companies who now come into a refinancing exercise will typically also keep that structure in place and refinance again as sustainability linked. Second, there has been in the first half 23 versus last year far less big deals in the market versus 22, which reduces the flow, and there is also an increased penetration in the mid-cap segment. The mid-cap segment typically also lowering amounts of issuance amounts because it's our smaller companies. Then again, it's what we see in the market. Whenever we have funding discussions with clients, there is always a consideration to look into either green social use of proceeds or eventually looking at general corporate purpose facilities with KPIs. So our belief is that sustainability linked is there to stay, clearly, but there will be a growth initially on use of proceeds for the coming years. Third point is the word transition. Transition is, of course, a very important one because there we can look at multiple angles. You can look at it from a sector perspective. You can look at it from a client perspective. You can look at it from a climate transition or an encompassing overall transition from the economic environment towards more sustainable economy. CSRD will require companies to have a transition plan being made public with a number of key topics, which makes that today we see quite some, I would say, stress in the market with our clients because they are anticipating the upcoming regulation and disclosure requirements also on in this logic. Transition plans is about decarbonizing, but it's also about specifically mentioning the levers to reach the reduction in CO2 emissions, for instance, and also about the funding considerations. And there we see a clear link with sustainable finance solutions because companies will make their own assessment how to fund the transition and the underlying CapEx requirement. You see also, I have included a number of pictures as well from Bloomberg New Energy Finance, specifically already a key takeaway. The SSAs has been historically a huge issue as well, the FI segment. And I've included a specific focus on a number of key sectors. You see a huge differentiation between either green bond usage or sustainability linked, depending on the sector. So that underpins the logic that you need to know your sector logic, you need to know the pathway of transition for your specific industry. Clear example, the hard to abate sectors, for instance, steel, cement, or the transport and logistics, the heavy means transportation and logistics. We are working as a bank also within the sustainable steel principles, and there are also the clear Poseidon principles to follow a certain decarbonization pathway on the shipping industry, which is fully aligned with the sector from, for instance, the IMO. Now, how will the future look like when it comes to sustainable finance solutions? If we look into those three topics, I think it's fair to say the time to act and the awareness around it, it has spread the world. Clearly, you can look at the climate clock. As we all know, the climate clock has been shown multiple times across continents, also at multiple conferences of the parties globally. We know that this decade is a crucial decade to act, and we see cooperation as very important. Cooperation driven by the industry at large, but also by the financial industry, because we support the transition with our asset book and the allocation towards the Paris climate goals. And that is also a clear strategy which ING has in place since already 2018. So business models will continue to evolve. Companies will look into technological innovation, cooperation. So when it comes to sectors, it also means you have to look into cross-sector view and value chains in order to look at new technologies which will drive the decarbonization and the change towards a more sustainable economy forward. So in the long run, there is a clear potential to have a growing demand on sustainable finance solutions, and eventually there might be also a little need for adaptation requirements, because we know we are facing, as we speak already, multiple issues on climate change around us. So with that, I would like to conclude the presentation on behalf of ING and open up for questions, please.
Thank you very much for this presentation. I think it's a very interesting angle to think of the impact of legislation on solutions. My question is, what would be the impact of legislation on the other reporting initiatives that are out there? And I'm thinking of the voluntary one. Yeah, I'm working for the PRI, so I'm a bit scared for my job. But more seriously, so do you think that there is a way for the reporting, the legal reporting, to cohabitate to some extent with the voluntary reporting that are out there? So I'm thinking of the PRI, for instance, or maybe GRESB for the real estate sector. Yeah, so that would be my question.
Yeah, PRI, GRESB are well known indeed, and important metrics to look at, and that will also trigger certain structurings when it comes to specifically GRESB, for instance. We can look into that also to structure a green loan for real estate sector clients. So those indeed are important drivers for sustainable finance considerations and funding solutions for clients. Yeah.
Maybe just, if I may add, on the EU Sustainable Finance Agenda, it should be looked at as a demand-driven policy intervention. And when you look at the impact assessments that underpin the taxonomy, CSRD, NFRD revision, et cetera, the overall conclusion in those impact assessments is that while there are voluntary measures out there, it's just not enough. So because there hasn't necessarily been a great uptake on the voluntary side, we have to make certain things mandatory, which is why you saw the change in the taxonomy regulation as opposed to how it was first presented by the European Commission. In the first instance, it was a really simple voluntary reporting template, and then through the course of co-legislative procedure, Article 8 was inserted, and the reporting was made mandatory for those companies in scope under NFRD. Of course, use of this information is still voluntary. But then when you look at the amendment of the NFRD into the CSRD, legislators looked and said, okay, we made it mandatory for 11,200 entities now. Now we need to expand that scope. So now it's CSRD with application to just under 50,000 companies with spillover effects elsewhere. So again, the general conclusion was voluntary wasn't enough. We need to make some things mandatory.
Hello, thank you for that presentation. If I might ask you to step back and maybe give us like a line or two on, what is the impact of these regulations on the interest or are there more clients? Are there more questions, new questions? More interest, so is there more interest, and what is the interest? If it's, if you wanted to summarize that in a sentence for sustainable finance and sustainable solutions.
So the question is, if I understood correctly, if there is more kind of demand-driven within corporates or issuers at large to look at sustainable finance solutions? Due to the regulation.
The first is there more interest, and then if you want to pinpoint it to one aspect, then what that interest would be.
Yeah, I think it's fair to say that indeed there is an increased logic to drive sustainable finance forward. Why? Because companies will have to make that reporting, will have to adhere, and you have the full stakeholder pressure within, for instance, board of directors setting guidelines also on sustainable funding. So companies who might not have sustainable solutions today might have a target to have X% of their funding portfolio being sustainable within a number of years. That's certainly an angle which we see. Maybe other considerations?
The way I kind of look at it is reputation is everything, and optics are really important. So companies want to make sure that they're presented in the right way to not just their shareholders, but to stakeholders at large. So integrating a sustainable finance consideration or opting for a sustainable finance solution will kind of get them there. But that's only one part of the equation.
Yelena. Amazing presentation. I think the example on the equivalences with the coal included in the Chinese taxonomy, I think it speaks very much on the work that still needs to be done in this aspect. Thank you very much again.